Hi everyone, welcome back to my channel. My name is Diana. If you're new, welcome. On this channel, we talk about personal finance, money management, and ways to make your money grow. If these are topics that interest you, consider subscribing. So in today's topic, we're going to be talking about the things that you need to know before you actually get started investing. And these things are pertinent to the stock market. So there are some basic knowledge that every beginner investor should have. And in today's video, I'm going to be sharing with you guys the basics of the stock market, the things that actually drive the market. Because when you're investing your money, you need to be well informed. You never want to go into anything without doing your due diligence. And in this video, we're going to be talking about all of the factors that affect the prices of the stock market. We're going to do a deep dive, and I'm just going to be breaking down some basic information for you. So if you have a pen and paper, I would advise you to get it because you're definitely going to learn a lot from this video. So to start with, what is the stock market? So the stock market is, like the name implies, a marketplace that you go to buy and sell stocks of publicly traded companies. And the stock market is also referred to as the stock exchange. Now, in the US, you have two major markets. You have the New York Stock Exchange, and then you have the NASDAQ. Now, on the international markets, you have several different international stock exchange. But just to name a few, you have the London Stock Exchange, you have the Indian National Stock Exchange, and then you have the Tokyo Stock Exchange. Now, in the US, there are three major indices that investors track when they refer to the stock market. The first one is the S&P 500, the second is the NASDAQ, and then the third is the Dow Jones. So I'm going to be breaking down to you what the S&P 500 is, what the Dow Jones is, and what the NASDAQ is. Because I'm sure a lot of you have probably came across finance news where they've mentioned, oh, the S&P is down, or the S&P is up, or Dow Jones or NASDAQ, and you're probably wondering, what are these indexes and what do they contain? So I'm going to just break down what consists of these indices. Now, these indices make up the total market value of all of the top performing companies in the US. So the S&P 500, like the name implies, actually tracks the top 500 companies in the US. It's tracking their performance throughout the year. The Dow Jones, on the other hand, is tracking 30 of the most influential blue chip companies. And then the NASDAQ is only tracking stocks that are traded on the NASDAQ. Now, the S&P was founded around 1957, and that has been one of the most used benchmarks when it comes to investing in the stock market. Now, according to the official S&P data, the S&P has actually averaged around 8% since the beginning of 2002 until 2022. And that's around a 20-year period. So most of the times you hear investors say, is their investing lining up with the S&P 500, or are they trying to outperform the S&P 500? Because historically, the S&P 500 has historically performed. And there is data out there that says that if you were to invest your money, you would definitely see a significant growth. Now, I'm going to give you a little example. As I mentioned previously, the S&P has given around an 8% return within a 20-year period. So we're going to use $100 as an example. So let's say that you had invested $100 from the year 2002 up until the year 2022. How much money would you have? If you actually invested $100 into the S&P 500, in 20 years, you would actually have $55,380.45. And you can see this is happening from year 0 to year 20, how significant your money would have doubled with compound interest. That's a huge return for just only investing $100. And again, that's the reason why I stress the importance of investing, because you can literally get started with as little as $100 and consistently throughout the years, compound interest would more than double your money. Now that we've covered the basics of the S&P 500, you might be wondering, what are the factors that's actually driving the market? And how can these factors actually affect your investment? So to start with, you have the law of supply and demand. So as you can imagine, the people who actually drive the market are investors. Now, investors invest their money based on several criteria. But in essence, when a lot of investors are buying a lot of stocks, they're naturally going to drive the stock market up. And when a lot of investors pull their money away from the stock, they're naturally going to drive the stock prices down. And a lot of these factors are typically due to company performance and many other things. So I'm going to give you guys an example, and probably a lot of you guys have heard about it in the news since we're talking about the law of supply and demand. Now, there was a stock that, due to the law of supply and demand, stock prices tripled because there were a lot of investors buying up the stock. Now, the stock that I'm talking about is GameStop. If you guys ever heard about GameStop, there were a bunch of investors from Reddit that pretty much decided that GameStop stock was just undervalued. So what they did was that they bought up a lot of stocks. Like, they bought up a significant amount of stocks. And because they bought so many stocks up, they naturally drove the stock market up. And as a result, a $10 stock easily became a $200 stock. I mean, the rate of increase was like around 400%. Now, that was probably one of the most historical things that happened that shows you the power of investors and how they have the ability to really affect a stock's price. Another stock that they also drove up the price was AMC. And AMC stock was another stock that was undervalued, that was originally selling at $10, and that price significantly went up. So a lot of people made out with a big payday. Now, another important factor is the bid price versus asking price. And this is super important when you're trying to buy stocks. Now, the bid price is the maximum amount the investor is willing to pay. And then the ask price is the minimum amount the seller is willing to sell the stock. Now, when both the buyer and the seller, they both agree to a price, then a sale is made. Now, we're going to be looking at the stock price of Amazon, what the stock price was when they opened the market, and what the stock price was when they closed the market. So as you can see here, the market previously opened at $92.67. And the market closed at $90.73. And if we look here at the top, we see the bid price. So the bid price was $90.95. And then the asking price was $90.98. So an important question to ask yourself is, if I'm an investor, what would make me want to invest my money in a particular company? Well, for me, I'm going to be looking at how profitable is this investment? Do I see a future in this company? Do I see the stock prices going up and me ultimately making a profit in the future? And that's usually how most investors are thinking. They're usually thinking about how they're going to make their money grow if they invest their money. Another thing that investors pay attention to when they are investing is the company news and data. So I'm going to give myself as an example. I am a pharmacist by trade, so I do read a lot of research articles and I focus on like new drugs that are coming out. And I'm sure a lot of you guys have probably heard about Ozempic and Wegovy. Now, these companies, because they have recently been in the news with helping a lot of people lose weight, their stock prices are going up because a lot of people are using it. And for an investor, that's good news because you're thinking, oh, wow, this company is really making innovations. They're really making differences in the lives of people. So if you invest your money in that company, then you already know that somewhere down the line, you're going to get a return on your investment. Now, some technical factors that a lot of investors look at is the price movement history. They look at the 52-week lows and the 52-week highs, and they're comparing the current price to see where that stock is in that range. Now, the 52-week range pretty much shows the price of the stock when it was traded within the last 52 weeks. So it's really important because it kind of lets you see if the stock price is actually trending upward or if it's trending downward. And that will be an indication to either buy or sell. So we're going to take a look at an example. So back to our Amazon data. The 52-week low was $81.43. The 52-week high was $170.83. So just by looking at the stock price, I can automatically tell that Amazon stock price is trending down. It's closer to its 52-week low than a 52-week high. And that indicates that maybe now is not the best time to buy the stock. 52-week lows can usually be due to maybe company performance or maybe just negative sentiments. How people feel towards that company or how people feel towards that industry can actually drive the price of the stock market downward. And the same is true with a 52-week high. It could be due to great company performance, or it could just be due to the fact that investors strongly believe in that company, and that's why they're driving the stock prices up. The way a lot of investors track the performance of companies is that publicly traded companies are legally required to release their financial reports. So for any company that you're trading, you can easily pull up their financial reports and see how the company has been doing throughout the quarters. So usually a lot of them report quarterly. You'll see Q1, Q2, Q3, Q4 reportings, and then you can kind of make an informed decision to see how well this company is performing throughout the year. Now, based on the financial report, if the company happens to do really well and they outperform the predictions of the financial analysts, then their stock prices are going to go up. And in contrast, if the company fails to meet profit goals, then usually the stock prices are going to drop. Now, another important factor, it's a technical factor, is valuation. And that pretty much means how valuable is the company. And you can usually calculate the company's value based on the current stock market price as well as the earnings per share. And valuation is called PE. And what PE pretty much stands for is price to earnings ratio. Now, your price to earning ratio is going to compare that company's stock price in relation to the earnings per share. Now, the importance of the price to earning ratio, or the PE, is that it's used to compare apples to apples, oranges to oranges. So pretty much stocks of companies that are within the same industry. So if one price is higher than the other, then you're comparing to see which one is the better buy. Now we're going to do a little example. We're going to calculate the PE of two companies. So for example, we're going to say that company A, their stock price is $33.49, and their earnings per share is going to be $2. And then company B, the stock price is $40 and the earnings per share is going to be $4. Now, once we calculate the PE, we can see that the PE for company A is 16.7 and the PE for company B is $10. Now, out of company A and company B, because both companies are in the same industry, company A looks like more of a better buy. So for investors, the higher PE usually means higher earnings. It means that the company is overvalued, means a lot of investors are very positive about this company. And the low PE means that you're not really getting a good amount for your buck. And it means that a lot of investors are just not that confident in that company. So that company is undervalued. Now, inflation typically increases the interest rates, and those higher interest rates reduces a company's cash flow, causing them to drop their stock prices in order for them to pull more money back into their company. Now, when we piggyback on the idea of supply and demand and inflation, we're going to take Exxon, for example. Remember when the gas prices were through the roof, extremely expensive? Exxon, because it was a gas producing company, their stock prices went up. A lot of oil companies, their stock prices went up because they were profiting in this state of the economy. Now, in contrast, other companies' stock prices were dropping. Another major thing that really shaped the stock market was the 2008 recession. When the housing market crashed, a lot of people lost their money in the stock market. Another most recent event that also affected the stock market was the 2019 pandemic, because a lot of people weren't going out, they weren't buying anything, and a lot of major retailers, specifically movie theaters, their stock prices dropped because people weren't leaving their house to go to the movies. But then on the flip, you had companies like Netflix profit off of the pandemic because a lot of people were home and their stock prices were through the roof because a lot of people were using their service. And last but not least, another thing that can really affect a company's stock price would be if they had any recent acquisition, any mergers, or maybe even bad news or bad press. Whenever there's a hint of bad news or bad press, a lot of the times investors will pull their money back because they're not trying to lose their money. And in the stock market, there are so many different sectors that you can invest in. If you're in healthcare, you can do the healthcare sector, you can do financial sector, you can do energy sector, you can do utility sector, you can do real estate. There's so many different sectors that you can seriously invest your money on. Before you start the investment process, make sure that you do your due diligence to see, is this company a best fit for you and where you see your money going in the future. Guys, well, I hope you loved this video as much as I loved filming it. I hope you learned one or two things. If you do, please go ahead and drop in the comment section so that I know that you absolutely learned something from this video. Thank you, and I will see you in the next one.